Stocks may be up so far in Q4, but our next guest says that could be a warning sign for recession next year. Tony Dwyer is the chief market strategist at Canaccord Genuity. Tony, great to see you. You've been listening into our conversation, and in the context of your call for the last quarter of the year was for the S&P to go up between 8 and 12%. We've gone through that. We've discussed that on the desk. So how are you viewing the rest of the year going into 2023?
So you're up now 13% for the quarter. You've never had the S&P 500 down more than 10% for the first 3 quarters, and then had the fourth quarter up more than 12%, which means you should give back some of the gain that we've got. But I think it's you got to be careful because you don't want to get too negative. The range at the year end, it was a year end call, not a during the quarter call. At the year end, we should be up, based on history, somewhere between 8 to 12%. We're up a little more than that, but it doesn't mean you go out and sell everything. I think, as you know, I'm expecting a recession next year. I'm pretty convicted on it, which means you go back down. But, that for the year end, we've already put it in. I think Karen hit that pretty much spot on.
So I take it, Tony, that when you look at the yield curve, what you see is the bond market's pricing in recession. What do we need to see out of the equity markets for you to believe that we are starting to do that as well? There does seem to be a disconnect.
It really, breadth comes in and you go back and retest the lows. It would be historically unique. So there's 3 things that, Mel, that we're looking at, and the viewers can track it. The 3 things we're looking at, it's not just the yield curves. Anytime the percentage of yield curves that are inverted gets above 55%. So you don't use the 210, the 3 month, people pick whatever one they want for the day. Let's use them all. Anytime you've had more than 55% of them inverted, you've gone into a recession. We have 82% as of early this week. We had 82% of them inverted. The leading economic indicators, anytime that you've had them at the current level, you've been in or going into a recession. And the Philly Fed diffusion at 1-month diffusion index, which is kind of an interesting indicator. It looks at really the 4 different labor metrics for each state, and the Philly Fed measures it versus a month ago when it's hit this negative a level, you've gone into recession. So I'm not, you know me by now, Mel. I change my opinion like 50 times a day every time there's a tick. So I got to go by the data. And the data is very clear that it would be historically unique with these indicators the way they are not to go into recession. And it would be historically unique for the market to not bottom during the recession. In other words, you haven't made the low yet.
TD, it's Tim. But there is some data, and there are some parts. There's a bull market somewhere, always, right? And so there's parts of what's going on both in the economy and in terms of asset allocation that should work now. I like gold here. I like emerging. I think some of the delayed reopening trades, like some of the airlines and casinos, and they have some fundamentals behind them. What do you do in this environment where we've had a 17% move off that CPI low in October?
I think you got to start getting defensive when you're above that 12% level and you're expecting a new low. As you know, I've been pretty neutral and been very tactical this year based on a whole bunch of indicators. So we had the fall. Now we've had the year-end rally. You've maxed that out. I think you start to get defensive the more above plus 12% you get, and as you exit the year. We're in the temporary sweet spot. The fundamental excuse for this oversold rally is that the Fed's initial moves have lowered inflation. Bono had this right, where the drop in the goods inflation, it's the note we wrote about today, the drop in goods inflation it's really coming down because we've transitioned from buying stuff. It's Christmas every day at the Dwyers with Amazon. The presents show up and you open them every day. From buying stuff when we're in a pandemic to doing stuff. And that creates a problem because the lower inflation on the goods prices are coming down, used car prices, those things. But the problem is, as Bono said before, you get a lift in the services inflation. And Jerome Powell said yesterday specifically, he doesn't expect housing related or non-housing related services to start dropping until next year. So you're in the temporary sweet spot where you've slowed it enough to keep the goods side down, so you're off peak inflation, but the services is going to keep it up above where they want it. And that creates the challenge for the Fed and the risk really into the first quarter.
All right, Tony, great to see you. Thank you.
Great to see you, Mel. Happy holidays,
Tony
guys.
Dwyer, happy holidays to you. Tony Dwyer, Canaccord Genuity. Bonwin, I'm going to ask you this. Do you think cash is a bad place to be for the next 6 months?
I don't. And the fact that we are seeing whatever way you're measuring inflation, the fact that you're seeing that inflation and treasuries come in is telling you that the opportunity cost of holding cash is lower than it once was. And then when you kind of factor in the risk that we're seeing in the market, I mean, it makes it at least maybe 10, 15, as much as 20%. I think that's a reasonable holding.
Are your clients, Courtney, gravitating towards cash?
They have been, yeah, not to my recommendation necessarily, but yeah, I've been getting that really all year. I think people are extremely nervous. You're seeing that investor sentiment, really seeing that across the board right now. As a long-term investor, it's just really not the place to be, but you are finally at least getting some interest on treasuries and bonds and things like that. But I do have a lot of clients coming out of the woodwork, so I have a lot more cash than I realize, which you're also seeing in the data. But people are they're not ready to invest it. And there is still a lot of cash on the sidelines that eventually does need to make its way in, both through individual investors and through institutions. And I'm definitely seeing that on my clients as well.
That sounds bullish. I mean, cash on the sidelines sounds to me like people have been really scared, and sentiment's better than it was, but they're still above cash levels. If you look at the Bank of America's fund manager survey, cash levels are still in kind of crisis mode, and I think this is a case where this is why, if you look at this chart on the S&P, and everybody knows we're trading great considering a 3% move yesterday, but that we're above that 200-day. Carter says this all the time. You can draw lines any way you want, but if you draw from that downtrend on Jan 4, you're kind of through that downtrend just a little bit. Let's see where we go.